The real estate market has experienced several crashes in the past. The most recent one was in 2007 when the market crashed completely with hundreds of thousands of homes going into foreclosure, multiple subprime lenders declaring bankruptcy and the market requiring government bailouts. The ripple effects of the 2008 crash are still being felt today. As for the present data, over nearly 3 years, housing market prices have increased an average of 41.3%. Over the last 12 months, housing market prices have increased 13.5%. However, some experts are changing their 5-year predictions due to the chaotic nature of the housing market. There are several indicators that could lead to another real estate market crash. Some of these include falling existing home sales, slowing of building permits being pulled, mortgage defaults on the rise, foreclosures rising and interest rates. Listed homes for sale with high days on market is also an indicator to look out for. Keep in mind that every market in the nation is different, and these are local indicators. These data points are extremely helpful in understanding what your local market will do in the future. That being said, these are just indicators, not a crystal ball, so do your due diligence as always. 1. Falling existing home sales. The first indicator of a real estate crash is the current existing home sales. The law of supply and demand drives most economic markets, and this is especially true with real estate. If there are more homes on the market than there are buyers, the market slows down, and homes start sitting on the market for longer periods of time before they sell. As home sales slow down, buyers are able to offer less money and prices start to decline. If there are way more houses on the market than there is demand, they are deemed less valuable. 2. Slowing of building permits being pulled. There are a couple of reasons that building permits are a good indicator of a real estate crash. For one thing, the construction industry is one of the largest industries in the nation. If the construction industry is booming, that means employment is high and the economy is doing well. For another thing, developers pay a lot of attention to the supply and demand of a market. When developers stop developing, builders stop pulling building permits, and the real estate market begins to slow down. 3. Mortgage defaults on the rise. Mortgage defaults are an important indicator of market crashes for 2 reasons. 1. Rising mortgage defaults can be followed by rising foreclosures, which leads to more issues in the real estate market. 2. Mortgage defaults are also an indicator of the overall health of the economy. If unemployment is rising and people are unable to afford their mortgages, it is probably a sign of coming trouble in the broader economy. When you fail to make your mortgage payments, the bank can put your loan in a default status. This can happen immediately after you miss a payment or months later, depending on your loan terms and state laws. After your mortgage ends up in a default status, you will need to catch up on payments quickly or the bank can foreclose on your property, which leads us to the next indicator of a pending market crash. 4. Foreclosures rising. Foreclosures were made popular by the 2008 real estate crash. This crash was caused in a large part by banks lending money to people who should not have qualified. Foreclosures occur when a homeowner, borrower, goes into default on their mortgage and is unable to catch up on payments. In this situation, the bank may be forced to foreclose on the mortgage and repossess the home. Nobody wins when the bank needs to foreclose on a property for several reasons. Usually, this happens when the homeowner cannot sell the house for more than the remaining mortgage amount. If they could, they would sell it instead of going through foreclosure. 5. Interest rates. Interest rates are a great indicator of the amount of money people will be able to borrow. As interest rates rise, homeowners will be able to borrow less money. As interest rates drop, homeowners will be able to borrow more money. Therefore, the lower interest rates drop, the more money homes will be able to sell for. As people are able to pay more and more for a house, prices will continue to rise. Thanks for watching. If you got value from this video, give it a thumbs up and subscribe to the channel. Share and see you soon.